All right. Okay. So welcome everyone to the why goal setting is very important, particularly this time of year. Now the webinar is sort of just to basically give you some background on, why we do this as part of the whole process of actually every sort of trading system. You should be sort of really sort of focusing on this stuff. Now, just to give you a bit of introduction to myself, so you know who I am. My name is Brad Gilbert. I'm the Managing Director of Traders for Traders. We set the company up in 2009. And really, it's sort of this year that we're sort of really starting to go global, basically. But my background is basically in investment banks. I spent the best part of 20 years on the front line of Forex desks at Citibank in Sydney, London, and New York, as well as back at the CTA in Australia and in New York, as well as TD Securities, going back and forward from Toronto to Sydney as well. So my sort of background is in trading, and this is where we used to do at the start of the year. This time of the year, it's absolutely imperative. As a chief dealer, I used to have to sit the team down and actually go through methodically what their budgets were and their goals and targets to make sure the traders were on the same page at the same time and getting them kicked off. Now, why is goal setting absolutely imperative? Well, basically, if you have no goals or objectives, you've got no purpose. What is your purpose if you don't have a goal or an objective? It's just actually sort of just to keep going and keep doing things. It's not the way that business or any sort of sport or any of those sorts of things are done. If you have no purpose, you'll have no plan, okay? And this sort of rolls straight into, if you've got no plan, there'll be no structure, there'll be no meaning. What you'll end up doing is you'll just drift aimlessly until you run out of money. And that's what, if you're trading in this business without any specific goals, your general structure will fall apart, and it's just a ticking time bomb, okay? Now, success is measured against goals, okay? We're just the college national champions, Florida State. Now, the whole process for any sort of, as I said, business or sporting organisation, it's the same thing. And you don't become champions overnight without having clear, specific goals. Looking at pre-season, setting the goals, preparation and the training before the season starts. Now, during the season, you're looking at each game plan for each match. Each situation is somewhat different. The same way we're looking at the markets. Each time you turn the machines on, there could be a different political or central bank situation that you're facing. You've got to adjust the plan for, say, injuries, results and conditions. These football teams, the finals preparation, performance psychology, making sure you've got your mind switched on to the events, and that you can perform at the highest level. And once you've got these goals set, you've got the potential to reach those goals and become victorious. So this is no different, though. As I was saying, it's very easy to sort of understand in the sporting concepts. That's why I'd like to sort of run you through that initially, primarily because we all love watching sport. Now, the results on the sports field are no different to business. Now, in the banks, I can tell you from my 10 years at Citibank, the same thing used to happen. As I said, you're setting budgets at the start of the year. Now, the last few years, my budget was $5 million. Okay, I had to make $5 million a year before I started getting paid bonuses on top. Okay, so what we generally do is now, when you're starting the year, you're thinking, well, and don't forget, the banks don't make it easy for you. Okay, on a good year, you might make $3 million. For some traders, that might be their best year. I sort of made about between 4 and 6 in a number of years, so they sort of sit there around that 5 as a bit of a tease to get you to sort of work harder to drive forward. But looking at that number, if you start the year and you're thinking, oh my God, I'm going to make $5 million, what you do is break it down to each match, each game, each cycle. Looking at the monthly target, $417,000, that's all I had to make each month. The weekly target, $96,000. Okay, so you're breaking it down, making it easier in your mind methodically to actually sort of take on this opportunity. The daily target, $19,200. Okay, reach budget, I get paid a bonus, and that's the situation I was facing a number of years there. And that's actually what got me out of bed each day and had the structure. So that was the goal. Now, that actually going through this process of having these targets a day, week, month, and year, it keeps you really focused on the job at hand and really makes you strive forward to take advantage of every opportunity and not waste any cash on meaningless, sort of boring trades that you might think were around. Now, what makes a better trader? They know when to trade. They know what to trade. They know how much to trade. They know how to follow the market. And they know how to understand how much capital they have at risk. Okay? But the most important thing is they have clear and decisive goals. Each day you walk into the dealing room, you should be thinking, okay, today's the day. I'm going to concentrate. I need to get that $19,000 up. Okay? If I have a good day and pick up a couple $100,000, well, then I've just made 10 days worth of profits. And this is what we used to do. If you have a good day and you get things right, invariably made a lot of money. At the same time, you wanted to manage your risk on the downside to make sure you didn't dig any sort of deep holes. Okay? So goal setting gives you structure. Okay? Capital management. That's the first and the most important concept that you need to get your head around. That actual capital management profile will come back, you know, in that banking situation where you have budgets. You can actually sort of apply how much you needed to make to how much risk you had to put on. And that's where they would place the limits around your loss and position size as well. But then your risk to reward ratios are perfectly matched up, and this sort of perfectly incorporates your trading plan as well. Okay, so if you've got that structure, then it's going to be very easy to keep focused. Okay, as you progress through the course of each week, month, and each year, you'll be consistently performing quantitative and qualitative analysis, collecting data, analysing your results, analysing the performance of the markets, compare your results, integrate, interpret, keep making sure that you're moving with the market. The FX market is extremely dynamic, okay, probably more so than any other market. So you need to be able to move with it. Having these clear, decisive goals will keep you focused on the job at hand so you don't get distracted and get lazy. If you start to get lazy and lose the process, you will more than less be placing trades with higher risk without even really knowing about it, okay? So when you do have specific goals, you know, it will signal when it's time to adjust, okay? If you're not making money and something's not working, you do have a goal here. You need to be making money, so you've got to adjust the plan, okay? So what it does is it kicks you into gear. If the results aren't coming forward, you adjust your plan according to what your goals need to be, okay? So this is the whole process. It actually keeps driving the whole system forward. And it can keep you on really focused on capital growth. Okay, you know, generally, if you don't have a specific goal, or any capital management for that matter, then you'll be sort of more or less trading, you know, around that sort of red line here that, you know, is sort of hanging around the sort of zero, if not going down the negative side of things. With good capital management and good focus on the structure of and the process you're going through each day, then that's where you have that blue profit line, which should just continue to keep gradually stepping up. As I said, it should keep you on the path. Risk-reward ratio is one of the key concepts that you need to have a grasp on. Okay, the minimum risk-reward ratio you will find any sort of bank traders operating on is 3-to-1 risk-reward ratio. Okay, so that's the minimum. Now, if you're trading and sitting there and thinking, well, I'm trading 1-to-1, well, you need to fix that up pretty quick, smart. Otherwise, you are not going to make money this year. Or if you do, you're going to make a very small amount of money. Having that risk-reward profile enables you to have a number of losses and still make a considerable amount of money. With a good 3-to-1 risk-reward ratio, you could only make sort of 40% of winners and still be making money. Okay, that's how important this is. And actually having those goals will continue to get you to focus on that makes sure that risk-reward ratio doesn't come unstuck. Okay, this will also make it easier to manage your overall performance. Okay, you are going to have peaks and troughs. Now, if you've got a consistent plan, you've got some sort of experience, well, then you expect to have losses, okay? Your whole structure is based on having winners, having losses, having losing trades and these sorts of things. You know, with that set structure, this isn't an evil situation for us. It doesn't even sort of upset us, okay? If anything, you look at the opportunity and go, well, okay, I've had a couple of losses here, I'm due a couple of winners. It's all part of the cycle and part of the structure. Having the consistent objectives at the end of the day will get you out of the doldrums. If you're feeling a bit down about what you've been doing, then this will really sort of change things somewhat. Now, setting performance objectives. Now, this is one of the hardest things to do for new traders or for retail traders themselves who haven't got much experience. You know, you might just sort of pick a number out of your hat. What you should be looking at is how much capital you've got. Well, I'll actually sort of go through it. We'll sort of talk about this. Now, before you start setting your performance objectives, it's really important you identify the following critical constraints that are in front of you, okay? Understand market conditions are both dynamic and unpredictable. One of the key things that people ask us before they come to our workshop is, how much money can I expect and how soon will I make it? Well, the answer actually is, you know, generally we teach you you're looking to make at least 100%. Our good traders are making 200%, you know, per annum. Now, with that, understand that, you know, how much money am I going to make and when am I going to start making it? Well, it depends when you finish the workshop, for instance. You walk out of the dealing room afterwards and you walk into say a situation like last September where the US government was shut down. There's a political storm all over the place. The markets were choppy for about 3 or 4 weeks, if not a little bit longer, because it upset the whole spectrum of Bernanke and the Fed and the tapering and everything was out the window. It became a bit loose and dynamic. Now, if you walk into a situation like that, a bit of a quagmire, it can take some time to really get the wheels moving. Okay, so that's what you sort of have to look at, and that's something that you can't control. Conditions also change rapidly and without warning. That's why we have a specific trade plan and capital management system protecting us, because the conditions in this FX market, it's a global market. We've got a number of anomalies and random events that can happen. Either central banks, politically, terrorism these days is not out of the realms. So there's a lot of things that you have to consider that, you know, can impede your targets. Market participants have limited resources, and most notably those associated with time and the ability to sustain losses. Okay, that's just about every trader on the planet. I mean, if you go back through, I guess Buffett and maybe Soros, now these guys are probably soaking up large losses. You know, if they're hedging some of their positions, which I know they do, they'll probably be offsetting those with some other profits in another area. That's why you have that diversity across your portfolio. It gives you the ability to take in some losses. But generally, for us, and as a general retail trader, most of us don't have the ability to sustain losses forever, and that's why we need to have specific targets. And with these targets, you know, it's the top side as well as the downside. Okay, this is one thing that most people underestimate or don't think about. It's actually, you know, you should have an optimum target return, okay, a nominal target return, and a stop out limit. Okay, if you don't have a limit where you stop, well then you'll just go to zero. Okay, the banks do not let you go to zero. Okay, sure, you might be in the negative, but they'll have a set number. If you reach that level and lose a certain amount that week, they will stop you trading, whether it's Tuesday or Wednesday. You don't trade that week. If you lose more and you hit your monthly level, then they'll stop you trading for that month. Now, if you do that a couple of months in a row, they'll sack you. Okay? Unfortunately for you, you can actually keep hitting your own account and keep sort of either topping it up or keep stopping yourself out. You know, if you don't have any structure, any sort of specific goals on the top side and the downside, you're going to come unstuck. Now, optimal target return. This is your best case scenario. Okay, you need critical self-assessment of performance during previous cycles. Okay, also review of current conditions, formulate an action plan. Okay, so what you really need to be doing is thinking, okay, I've got say 100 grand in my account. I'm thinking, you know, my optimum result is 200%, so I'm going to be picking up 200 grand. That's if everything fits into place. Okay, now for those of you who sort of think that these are sort of crazy numbers, and we're risking 2.5% to make 7.5%. Okay, you put one good trade on a week. Okay, you're looking at about 350%. Now, generally, we aren't trading every week, so we sort of take out, say, 10 weeks of that for holidays and things like that. And we're looking at different opportunities where you may not maximize that full 7.5% profit. But still, at the same time, you should be sort of looking to make 3 to 5% per week. And that's where you're really going to be making, as I said, close to that 200%. One of the biggest problems you'll have in reaching some of these targets with more money is actually executing the trades, because once you get over that $3 million mark, trading on some of these retail platforms becomes somewhat bit of an issue. Now, nominal target return. you need to make a realistic assessment of all aspects of your portfolio management environment. Okay. Then operating within these constraints, what is the minimum performance I would consider satisfactory? Okay. So say we set our optimum level at 100 or 200%. Your actual, your minimum performance, maybe that's 50% or just 100%. I'm not sure. So depends on each actual trader and their risk appetite. You know, say your optimum level is 100%. Well, then I think, you know, realistically in this environment, you know, you pick up 6 or 7 winners. That's 50%. Okay. So when you're looking at this spectrum, if you can't get 7 winners in a year, you've really got something wrong, or you're doing something wrong. And with that, you need a complete team overhaul. You need to change everything that you're doing and actually reassess what knowledge you have, how your structure of your capital management is set, what broker you're using. You need to turn everything upside down and sort of start to really sort of work out what's going on. Now, the stop out level. This is actually one of the sort of obviously the key parts. It involves setting your loss assumption tolerance at manageable levels that will afford you much greater control over the broad and diverse circumstances that you're likely to confront over the course of your trading career. Now, this is, you know, everyone's, I know, it's not about how much you could risk and who's the most risky trader. It's about who's got the most control. Okay? This is about the amount of loss you're willing to underwrite that really determines your money-making capacity. Okay? This is exceptionally important, and you should actually be doing this as a trader, is actually sort of sitting back and actually sort of working out what your limits are for the week. Okay? So say, for instance, you've got, say, 100 grand in your account, for instance. Now, if you lose, say, 5% or somewhere between 3 and 5% for the week, you know, I would encourage you to stop trading, primarily because you're out of whack with the market, or you're over trading, or the market's out of whack and you just don't recognise it. So you've got to have these weekly, monthly limits to yourself. That's actually will get you into the professional mindset to actually trade a lot more efficiently and actually potentially reach your targets better. Now, setting appropriate exposure levels. There's a couple of different methods here. I'm not going to sort of spend too much time on these. You know, you're either looking at the inverted Sharpe ratio, or secondly, as a percentage of trading capital. Now, most retail traders that I've come across don't have a Sharpe ratio. In our master trader course, we do use Sharpe ratio, and we get our master traders building their Sharpe ratio. That's more primarily because we're building those traders to, you know, potentially manage accounts, manage wholesale money out of our trading company. So that's the sort of profile we've got there. But what we actually teach in the expert trader program is traders to, you know, set exposure levels as a percentage of trading capital. Now, this method is best adapted to determining a lower bound of exposure that is consistent with reaching your target objectives. Okay, so your maximum drawdown, you know, in a professional scene should not exceed 10%. Now, as it is with the expert trader program, private investors have the ability to make a lot more money. So what we do is, with that profile, is increase the maximum drawdown towards that 20% level. Okay, so if you're putting in $10,000, you're risking $2,000 to make an unlimited amount of money. Now, we've had one of our guys in the last year put in $5,000 and turn it into $219,000 in 12 months. Okay, obviously a great result, and very good sort of risk management and taking advantage of every opportunity that came up. Now, looking at so our methodological approach begins by introducing the concept of trading capital, which is the sum of your maximum loss tolerance in your period to date P&L. So your trading capital equals your risk capital plus or minus your P&L. Okay, so as you're making more money, increasing your trade size, you're exponentially making more money. Okay, at the same time, you're reducing your drawdowns regardless of where you are. Even if you're up, say, 10, 30, 20, 30, 40, 50%, you're still going through that drawdown process. Now, it's a very simple method, percentage of trading capital. As the figure rises, we have more room for exposure and can expand our risk-taking accordingly by taking on larger positions or by deploying larger amounts of capital into new ideas or some combination thereof. you can start to diversify your risk a bit more. You can start to trade multiple currencies. You can actually place bigger trades on opportunities that you know have greater opportunity or greater potential. Now, by the same token, as trading capital is diminished, of course, negative consequences of risk taking, you've got to contract your actual trade size, and that's actually the whole system of our capital management system itself is actually geared up for exponential growth, but with minimal drawdowns. Now, adjusting portfolio exposure, understanding the alternatives. Now, you've got an objective, okay? As I said, you've got an optimum level and a nominal level. Say your optimal level is 100%, and you're having some difficulty. Well, understand the alternatives to adjust your trade plan and your structure to look for better trading opportunities, to get the wheels moving forward again. Now, directional bias. Start to look closely at the bias of the currencies and look to go with that bias. Currency volatility. Are you trading around when the currencies are exceptionally volatile? I mean, I know a lot of traders that like to sort of, big note themselves and say, I trade the non-farm payrolls. I'd say we must have traded 2, maybe 3 out of the last 12 months. They are an absolute bloodbath. Go back 3 or 4 months, they were great, but then now it's sort of a bit messy again. So understand, just trading the biggest volatile event doesn't make you, a better trader. It actually makes you probably a little bit crazier. Time horizon. If you aren't being successful in one time zone, then probably try another one. Okay. At the same time, diversification. If you're sticking to one currency pair, you're really limiting the amount of performance that you can probably expect. Okay. Each currency goes through a cycle over the 12-month period where they will go from being extremely dormant or even just following other currencies to actually being in control and moving themselves. Okay. So you got to get that diversity across your portfolio. Also, utilising the leverage available. Now, on the outset, we train our traders to trade with 10%. But as you start making money and you start making 10, 20, 30%, we are starting to increase the leverage and use the amount of, the leverage that the brokers actually give you to use it to your advantage so you can use less capital in your system, but you're actually trading bigger at the same time. Last but not least, this is one thing I would actually tell you to probably stay away from, options. I mean, if you're an options trader, and I've met very few that have made money over a long period of time. I probably, as I said, my budget at Citibank when I was in my last couple of years before I changed banks was around that $5 million mark. I averaged somewhere between 4 and 5 or 6 million bucks in those years. But at the same time, that was my net profit. I would spend somewhere between 4 and 5 million on options each year, protecting positions, looking for risk opportunities and these sorts of things. And one of the senior management used to always say to me, if you didn't spend so much on options, you'd make twice as much money. I never really saw it like that. They were more like insurance policies against some major moves where I was managing a lot of hedge fund risk. But, options trading in general is one of the last alternatives that you should do. And it's really used by traders who can't handle the risk. They can't handle their emotional state. So what they do is they go and lock in their loss straight away and then try and trade out of it. And that's exactly what you're doing with options. But I want to put it there because it is a viable thing if you know when to do it. It's all about the timing. And you get the timing right. And as the marketing says, you can make a lot of money very quickly. So what you need to do is focus on the job at hand. Okay. This is what having those targets will do for you. Okay. The benefits of maintaining your plan and your goals and keeping those objectives right in front of you at all times. It will protect you and make sure you stick to your trade plan and really protect you against these black swan events. Okay. High impact, hard to predict, rare events that can wipe out your account if you don't have sound capital management and a whole sound trade plan for that matter. Okay. These will continue to pop up as they have done since the 1850s through to 2010. And as you can see in the clouded area there's a whole spectrum of things sort of bubbling away, potentially sort of blowing up. And, we've got, Europe, we've got the US debt situation, which is still unresolved. We've got a number of key things here that could potentially blow up in an instant. So that's what you're having these goals and objectives keeps you focused on the trade plan and actually will allow you to manage the drawdown process as you go through this. So as I mentioned before, you're going to spend 80% of your time in an unhappy state known as drawdown, right? That's part of the plan. Don't get sort of bent out of shape. Don't get all emotional about this and start to think, well, I'm losing money here. Well, that's part of the actual business and part of the actual plan. Your target, your objectives and goals will have already factored in a certain amount of losses through the course of the year. Okay. So when you get there, it's not nothing to be upset about. It's actually sort of part of the plan. You know that this is actually taken into consideration with your goals and with your targets on your objectives. So looking at the focus of the job at hand, this is part of our sort of capital management profile with an account starting at $10,000. Understand, like you've got a target, for instance, okay? We use these separate levels. So you started with $10,000. Level 1 is $15,000, level 2, $25,000, level 3, $40,000, level 5, $75,000, or 4, sorry, level 75,000, level 5, $140,000, level 6, $270,000. These are actually the targets that we actually set for our traders to begin with. So you've got clear levels. You may have an optimum level of, say, 100% profit, but I can tell you, once you get trading and you know what you're doing with good capital management and a good understanding of the market, you don't have to do a lot of trades to get from one level to the next. Okay, those red numbers are the number of winning trades that you need to make the money to get to those levels. Now, understand, when you are focusing on the market each week, each month, there are a number of opportunities which are better than others. Okay, and you've got to understand, when these opportunities arise, that you need to switch on and get your trade plan into action if you want to reach that optimum goal and targets. That you need to sort of really crank things up. These are high impacting events. They are better trading opportunities. You need to increase your trade size and get aggressive and do this. Clearly, you can't do this if you don't have any understanding of how to trade the economic numbers. It's one of the key things that we do, is actually train people to trade live economic data, as well as looking at the general technical levels as well. But this is where you're going to make a lot of money, and that's where a lot of people don't understand it. They're actually sort of a bit spooked by the economic numbers. But I can tell you, that's where the direction for the currencies comes from. Okay? So depending on where you're at, this is where you really leverage up. If you've had no losses, well, then you get an opportunity to have a real crack at this. If you've had some losses, well, then I wouldn't be sort of encouraging you to sort of step up and have a number of trades on this, because you're going to be sort of potentially digging a hole if it goes pear-shaped. And you've got to have that in the back of your mind at all times. So looking at an example, for instance, say you're at level 1 and you're looking to get up to level 2, or the next level of growth, where you do increase your trade size from 200,000 to 400,000. What we would be looking at is an opportunity, say, like, for instance, we just had the retail sales numbers. It is a high impacting event. Say you've had no recent losing trades. We have a structure where we have 4 trades. I won't sort of go into it too much. It's a little bit of it'll take me another webinar to do that one. Decide to place the 4 trades. So you're trading $800,000 instead of the usual $200,000. Now, there's 2 scenarios here. If you get a winning trade, obviously you reduce the number of trades to get to that next, profit level, next level of growth, where you will be increasing your trade size to 400,000. You reduce that by 4 trades. So you can really make some good inroads here into your profit to reach your goals and targets by focusing on these key events. Okay. If you have a losing trade, well, then you're going to be decreasing your trade size. It is a dent into your capital, but at the same time, that was part of the plan, and you are now sort of trading less, but you're now looking for the next opportunity to get that cash back. And, what do good traders do? They don't sort of go chasing their money straight away. They look for the best opportunity. And that may not be straight away, may not be the next day, maybe the next week. Okay? Now, a bit of a tip. If you're down 2 or 3 trades, and you're having a bit of a bad run, don't chase the market. Wait for a directional, high-impacting trade to put you back in the game, and that's where you're going to get the confidence back in your account, or the money back in your account as well, to really push forward and get back on the track towards those optimum targets. Low risk, high probability. As I said, these are the opportunities that you really need to be focusing on. Obviously, knowing how to trade the actual economic events is probably the key part to it. But, if you've got technical analysis and fundamentals coalescing, that's when you have the opportunity to make exceptional growth very quickly, with a good sound capital management plan, and set goals and objectives, this is where you're going to really sort of take your trading as to another level. You know, levels that you probably have totally underestimated that you thought you could make, these are obtainable. You just need to sort of get out of your comfort zone, get into some actual real professional education, I guess, and then actually sort of work out how to sort of put the trades on. Okay, what that will drive you forward, it'll give you more consistent capital growth. All right, so that's the ultimate part of it is, why do we have these goals and objectives? It gives you more consistent capital growth. As I mentioned, you know, even with the Florida State College team, you know, if they didn't have their lofty targets and goals and objectives, they wouldn't have had the drive to keep going through each of those games, and even coming back from, you know, was it 1 minute 15 to go and still being down a touchdown and actually score the touchdown and actually win the game. This is actually how winners actually perform. Okay, it's about goals and objectives, and this time of year you need to really sort of focus on what you're doing. As I said, having optimum, nominal and stop out levels is absolutely imperative to your success. All right, that's pretty much a wrap. I mean, I didn't want to sort of drag it out too long. This is a few little components from our training program, but some things that you need to sort of consider. Obviously, the capital management program itself that we deliver actually sort of covers most of that, so you don't have to sort of worry about your stop out levels. They're already sort of in place, as well as your exponential growth levels. We increase your trade size as you continue to trade as well. All right, now we've got a couple of questions here. What time frames do you trade and what time frames do you recommend? Isn't this funny? I mean, I always get the questions that have nothing to do with what I was talking about. Now, general time frames that the banks actually look at, what we're looking for is, you know, bankers don't look at anything under an hour. Okay, so you should be looking at hourly charts. They're the ones that are going to have all the answers. When you're actually looking at the hourly charts, you'll be looking at the market with the rest of the wholesale market. Now, when you're looking at the wholesale and retail market, you know, 92%, well, 5% actually, I should say, of traders make up the wholesale market. Okay, but that 5% controls 92% of the volume. If you don't know what they're doing, you're out of the game altogether. Okay, that's first and foremost. Can you show a list starting with CPI? So I'm not sure what you mean there, Boyke. All right, so you mean go back and show you the actual list of the actual data releases? Sure. Well, I mean, this is sort of standard stuff. You know, CPI, GDP, retail sales, the unemployment rate and change, housing data, and the central bank announcements. These are all specific components that you need to be sort of very aware of, that these events are actually very high impacting. You know, the central banks themselves, this is one area that I found, you know, the retail trader, you know, may understand a few things, but understanding how the four components of a central bank, rate decision, the statement and the minutes, how they're rolled out, how they deliver the speeches, the mannerisms of the governors as they're talking, the way they deliver their speeches, and the Q&A afterwards, they're the specific things that you really need to focus on. Now, a 2-to-1 risk-reward ratio would not be suffice. No, it's clearly not. As I said, if you were looking, you should be thinking that you're trading, this is a business, okay? I can tell you the business is making money and the bankers are the best at it. Now, their minimum risk-reward ratio is 3-to-1. If you're looking at 2-to-1, you're kidding yourself, okay? All you're doing is, you know, why would you use a 2-to-1 risk-reward ratio? I can tell you why. You don't trust your knowledge, you don't trust your trading system, and you've probably got very poor capital management. Okay, so you really need to change the structure of that risk-reward ratio. Otherwise, you're never going to reach the lofty heights that you know, probably set yourself. So just swing that around, James. I mean, I don't mean to be harsh there, but it's one of those things that you need to sort of have a look at yourself and go, no, 2-to-1's not good enough. 3-to-1 is the minimum. Okay, when we're looking at trend trades, like good trending opportunities, you're looking at sort of 8, 9, 10-to-1. That's where you can really open it up and make some good money on good trending opportunities. We haven't seen those for a little while, but next time they do pop up, we will be doing that. With the $5,000 account last year, what was the maximum risk taken per trade? Well, with that, you would generally sort of be trading 10%, so you're looking at a $50,000 trade amount. So if you had a $5,000 account, that's what you had in there, and you had no losses, well, then you'd potentially be putting on a trade of $200,000 on that trade. Of course, depending on where you are, whether you're in North America or in Europe or in Asia, it will depend on how much leverage you've got. But generally, with $5,000 in your account, I would sort of generally say you should be trading a trade size of $50,000. That actually gives you a good structure to, keep making money, have minimum drawdowns. But on a good trading opportunity, you should be pumping that up to like $200,000 in the trade. Okay, good question. Right, any other questions there, chaps? Okay. With the 3-to-1 risk reward ratio, I mean, as I said, you can have actually the question is what win percentage is okay with 3-to-1? Well, you're looking at about 40%. And as I said, we actually train people to identify low risk, high probability trades. So we're looking for a 70% plus success rate. And as I said, you get down to that 40%, you can still be making money, a lot of money with that 3-to-1 risk reward ratio. The question there is, it's actually quite not funny, but the question is day trading viable for a beginner? Okay, James, well, of course it is. We've trained a lot of people who have had no knowledge about stocks or FX or anything and actually had them making money straight away. Now, what you have to understand is being a Forex trader, you're not a day trader. Okay, the Forex market's open from Monday in Asia to Friday in New York. Okay, so you're actually trading through the whole spectrum of all those days. It's like one big giant day. Okay, so what you need to do is focus on good capital management, number one. Okay, have a complete understanding of the fundamentals, and these are the two components that we actually cover very closely. Is actually having a look at the, understanding the fundamentals, and not just understanding them, but being able to trade them. Okay, one of the key parts that what you need to be looking at is get your capital working for you with control. You can do that. You'll actually be having fun with this. And if you're not having fun trading, then it's going to be a horrible experience for you. Having the structure will make it fun. Having those goals and objectives keeps you driving you forward. Can you brief the first part of the webinar? It was about goals. Well, basically, you just need the goals and objectives primarily because they're actually going to drive you forward. We're setting the structure for your general target. So your trading week will be determined on, for you to achieve that optimum goal, say it's 100%, you can break it down into a monthly, weekly, daily target. One thing that we try and take away from new traders is actually putting too much pressure on them with the time frame. As it is with the banks, they actually are regimented because they do, pay bonuses and things like that. So you actually have to have a sort of set schedule for that. Taking the time frame out, all we're looking for is try and get into your mindset. We're teaching you to make 7.5% per trade. Okay, how many trades a week do you need to be successful? Well, bloody one. Okay, you get one good trade a week. Okay, as I said, even if you're only trading 40 weeks of the year, that's well over 200%, and that's what you should really be looking for. Okay, so now I'm not sure if this was recorded. Actually, I forgot to check at the start of the presentation. What percentages are your fundamentals and technicals? Well, it depends on what's coming up in the market. Okay, this is one of the key things. Well, we trade a lot of economic numbers, and then we watch a whole heap of the other ones. What you should be looking at is trying to get a combination of fundamentals and technicals. But different times, different periods of the market, different times of the year, the fundamentals predominantly give you direction. The technical levels give you clear entry levels. Okay, if you don't understand those two things, well then you're going to come unstuck. So I guess weighing them up, we look for a combination of both. Predominantly though, a fundamental trade is the winning trade. Just trading technical analysis is a bit of a mess. It's a quagmire. It's like a minefield. Okay, it doesn't tell you anything about direction. It doesn't tell you about what's happening in the market at the time. All it does, it tells you where you can get in and where you can get out, and that's about it. So I'd say if you're looking for a percentage breakdown of fundamentals versus technicals, you're probably looking at 70-30. Okay, but the 30% will probably have a combination of fundamentals and technicals, and they will be absolute winners. as I was just going to mention there, just to sort of wrap up, I mean, it's been a pretty good sort of flowing sort of webinar. We've got that. If you want to go to our site, we do have the free morning market update video. You can easily register for that, and that'll go to your inbox. I think it's emailed out each morning. That'll give you a bit of an update with regards to what's happening in the market. Sort of keep you tuned into potential opportunities coming up as well. All right, if there's no other questions, I think that's pretty much a wrap. Thanks very much, everyone, for joining us. As I said, this is supposed to be quite educational as much as anything else. We want you guys to sort of make some money. If you look like you're struggling and you need some more help, by all means, come to our website, contact us, and we can set you on the path to success. Thanks very much. All righty, cheers. Thank you.